In this topic, we'll focus on what actually makes a customer or transaction high risk. You'll see how product, customer, geography, and channel factors come together, how structuring and threshold manipulation work, and how these classifications drive enhanced due diligence and monitoring. Think of your AML system as a classification engine. It takes raw customer and transaction data and looks at how risk factors intersect, who the customer is, what products they use, which channels they prefer, where activity takes place, and how behavior evolves over time. Risk isn't one thing, it's the combination that matters. The aim is to move from inherent risk to proportionate controls. When that combination crosses a threshold, the customer is classified as high risk. That's not a punishment. It simply triggers enhanced due diligence and closer, ongoing monitoring. In AML and CFT, inherent risk is usually viewed through four lenses: who, what, how, and where. Who is the customer profile? For example, PEPs, high net worth individuals, or cash-intensive businesses. What is behavior? Deviations from the expected pattern, like rapid fund movements or reluctance to share information. How refers to the product or channel, especially those offering speed or anonymity, such as private banking or certain crypto services. Where is geography? Jurisdictions on FATF gray or blacklists, or known secrecy havens. When we assess high-risk customers, we look at two dimensions: who they are and how they behave. Static risk is about the profile. Cash-intensive businesses, complex corporate structures, non-residents, PEPs, or customers with negative news all start with a higher baseline risk even before they transact. Dynamic risk is about behavior. Large or unusual cash activity, rapid in and out, flows through multiple accounts, unexplained third-party payments, or pushback on KYC questions all increase concern. Effective AML work combines both views rather than relying on just one. Customer risk is only part of the picture. You also consider what products they use and where the money moves. Products with high limits, rapid movement, or complex structures are inherently more attractive to criminals. When you add remote non-face-to-face channels and high-risk or opaque jurisdictions, the overall MLTF risk can increase dramatically. Criminals know that banks and regulators watch for certain reporting thresholds, so they design deposits to slip just below those trigger points. Structuring is the classic method, taking one large amount of illicit cash and breaking it into many smaller transactions to avoid automated alerts. Smurfing adds people to the tactic, using several Smurfs who each make small deposits that look normal on their own. Threshold manipulation is the overall strategy, timing and sizing transactions just under known limits to quietly move dirty money into clean accounts. All of these behavioral indicators point to one core idea. Someone may be trying to avoid detection while moving significant cash. Focus on patterns, not single events. Structured deposits, spreading funds across accounts or locations, or shifting from low, infrequent activity to regular, threshold-hugging deposits should always trigger curiosity, additional questioning, and possibly escalation. Now imagine you're the relationship manager for this small restaurant client. On paper, they report modest turnover, but you see regular cash deposits just under the reporting threshold, spread across branches, and spikes in deposits when the place is almost empty. Money moves between several personal and business accounts with no clear purpose, then flows out to high-risk countries as vague consulting fees. Taken together, these features push the customer into high risk, justifying escalation and a SAR. Consider a second case. You're reviewing this brokerage client, a foreign holding company with several offshore subsidiaries. On paper, it trades only liquid blue-chip shares. In reality, ownership is hidden behind layered entities, documents are thin and constantly changing, and trading looks like rapid in-and-out wash-like activity, with large cross-border transfers to related parties. None of those points alone prove laundering, but together they justify a high-risk rating, enhanced monitoring, and senior management involvement. Now look at a crypto-heavy scenario. A customer constantly converts large amounts of cash into crypto. The fiat comes from several bank cards and accounts. Then the coins are rushed through multiple wallets, mixers, and into exchanges with weak controls. On-chain analysis shows peel chain-style transfers and links to previously flagged addresses. Taken as a whole, those signals justify a high-risk rating, immediate enhanced monitoring, and likely preparation of a suspicious activity report. When you assess MLTF risk, don't just add up basic factors. Look for multipliers that can push a seemingly normal case into critical territory. An opaque or unverifiable source of funds or wealth means you should immediately question everything else you're being told. Adverse connections to corrupt actors or organized crime, or repeated attempts to bypass EDD and policy, also multiply risk. Finally, heavy reliance on intermediaries or professional enablers without a solid business reason is a strong signal that sophisticated concealment may be occurring. High-risk status is not a ban. It's a signal to tighten control. First, you deepen due diligence. Independently verify beneficial owners and validate source of funds and wealth. Next, you move the customer into enhanced monitoring with stricter thresholds and more frequent reviews. If concerns remain, the relationship goes to formal governance. Senior management must actively approve onboarding or continuation. Finally, you apply dynamic review. Shorter risk review cycles, so the rating and the control intensity adjust quickly as behavior changes. High-risk classification is never one-dimensional. You always assess customer, product, channel, and geography together. Then you track behavior. Structuring, threshold gaming, and unexplained rapid movement are your strongest signals. Adapt red flags to each sector, and once risk is high, escalate. Enhanced due diligence, closer monitoring, strong governance, and frequent, well-documented reviews.